Financial reporting is a branch of accounting that deals with the financial statements. Now, this branch is underpinned by the regulatory framework. And why the regulatory framework? It is because the regulatory framework quality assures the financial statements so that the users of these financial statements are safeguarded because the financial statements have already gone through a quality assurance process. And as I've said, is to safeguard the investors. They may be potential investors, existing investors, shareholders, and other stakeholders that will use the financial statements to make economic decisions, whereby the resources may flow out or flow into the entity based on these financial statements. So you'll find that we have got a comprehensive regiment of rules and concepts and principles of accounting that we are calling the regulatory framework. In this framework, you are going to find things like the company law being part of it, other regulations that governs how a company is managed. You are going to find also the accounting standards. You'll find the conceptual framework and others depending on the jurisdiction. So, if you have ever heard about the generally accepted accounting practice, those denotes the regulatory framework that is being used in a certain jurisdiction. And that leads us to the UK GAAP and the US GAAP, meaning that we have got a set of rules in the UK when preparing the financial statements that have to be followed, and we also have got another in the US and in other jurisdictions, because at the moment we have not yet reached a point whereby the whole reporting system has been harmonized. Although there is always that effort and there is always that ongoing project. But the main point that we need to mention here as we start is that there are rules. And you can imagine what could happen if there were no rules. You'll find that the world has survived so many crises. It has survived the war, it has survived COVID, which is fairly recent, but the most important thing is that you have to note is that the world is not likely to survive a financial reporting crisis. That is a tall order. You see, the world is not likely to survive a financial reporting crisis. And this experiment has already been done by our classic example, the Enron scandal. The Enron scandal showed us what would happen if at all there are lapses in the financial reporting system. Because this company, which was a US company, when it collapsed, when problems started, it affected the whole world. It became a global crisis. And it was just one company. And that's why I'm saying that although the world has survived many disasters, the financial reporting disaster has got such a big effect and has got such a big magnitude that the world is not likely to survive. Imagine what would happen if the Fortune 500 companies are affected by a financial reporting crisis. It would mean the world economy as we know it today, it will come to a collapse. And if at all the economy has collapsed, what else is left? That is a crisis of a very high magnitude that no resilience is likely to make us survive. And that is why financial reporting is always safeguarded. That is why it is heavily regulated, depending on size. For example, we have got small companies and we have got huge companies. We have got public interest companies that we call the PAIs, and the regulation increases as the size increases. And that leads us to the big gap. Big gap means that big companies have to go through more rigorous regulation, which increases the compliance burden, and also it increases the compliance costs. Now, the small entities or the small companies also are subjected to what we call the retro gaps, and these are generally accepted accounting practices, but some of these are topics for future discussion. But today, our main interest is on the conceptual framework. We have already mentioned this before. The conceptual framework is the accounting encyclopedia because it defines the elements of the financial statements. You see, the conceptual framework is very important because it tells us what qualifies to be an element and what does not qualify to be an element. And like we said before, when we start our journey of building the financial statement, we have to start it at the right place. We have to start it at the right place. And we say the right place is at the elements of the financial statements. So elements of the financial statements are defined because these elements are the building blocks, is what we use to build the financial statements. So they are anchored in the conceptual framework, meaning that not anything makes into our financial statements. We are doing this as a filter. We have to filter this quality assurance such that somebody who will depend on the end product to make economic decisions will not end up losing their investment, losing their wealth, losing their resources simply because they depended on illegitimate financial statements or bogus financial statements. So the regulatory framework is the one that strengthens the financial statements so that wherever you are, you can depend on them and make a decision. Make that investment decision. Put your pension fund in a certain company. Buy some shares in a certain company. All of this is dependent on that. You want to buy a company. You want to know the value of this company. You still depend on these financial statements, which are produced or prepared by adherence to the rules, by following the rules. Otherwise, the whole system will fall in shambles. And that's what happens again when we are auditing. We'll be looking at compliance. Did this entity comply to the rules that are out there? Yes or no? Then from that, we'll be able to bring together appropriate and sufficient audit evidence so that we can be able to express an opinion of what happened. If it is good, we put a good stamp. If it's not good, we put that particular stamp that shows that. You see? So, back to the elements, we say that as we build these financial statements, we need to have the right mindset. We need to formulate a structure. And this structure goes in this manner. We start by defining the elements of the financial statements. Then we record in the books of accounts. This is what we are about to do right away. We record in the books of account. After we record in the books of account, then we balance off those records. We balance off those records. After we have balanced off, we extract a trial balance. Then, with the trial balance, we can now prepare the financial statements. Meaning that when you have a trial balance, you are more than 90% complete in the journey. You have already covered more than 90% of the journey. So it's from the elements, then we record. And that is why today we want to record these basic accounting entries. We started it before in the previous video, but we could not finish. So today we want to carry on. We want to record these business transactions or these events that took place in this particular business. And when we are still there, remember that you have to master from day number one. From the onset, you have to master. And how do you master? You master by understanding where things are anchored, where things are going. Like we said before, everything in life has got an approach in which it is done. If you don't want to do it correctly, you have to use the right approach. And that's why last time we introduced those elements, because those elements will help us record these transactions. And when we are recording these transactions, we are not using guesswork. No, we are not using guesswork. We are using well-grounded information. It's what we feed into our records. So we have to have the information correct before we can proceed. And that's why we started with the elements, and we saw those 5 elements, and then we saw how they behave. The most important thing is to know how they behave. If you are to add, what do you do? If you are to subtract, what do you do? We saw all that. But now, let's continue and see. Let's continue and see how we are going to fare in this recording. So I'm calling you into this party. This is like a party to me, because this is very exciting information. This is very exciting work to do. So we have got our business here, and we are saying it's a sole trader, meaning it's not yet incorporated. If it's incorporated, it becomes a company. And the difference between a sole trader and a company, it is how the capital is expressed. If you see share capital, automatically you know that you are dealing with a company. If you see current accounts and capital accounts and see names of partners, then you know it's a partnership. If you just see capital only, then you know it is a sole trader. Like this is a sole trader that will help us to deal with the recording. And what we do here, it doesn't matter the nature of the business. The same will be the same. The same will be done. Irrespective of the size or the nature of the business, the same will apply. You see? So it doesn't matter, it's a sole trader, it's a company, it's a partnership, it's a small entity, it's a big entity, it is Walmart, it is Google, it is Amazon, it's Apple, it doesn't matter. As long as you get this right, then you can deal with the transactions of any entity moving forward. So here we are. We have got the transactions for the month of June for this particular entity, and the year is 2017, meaning the financial year is 2017. A financial year would take about 12 months or 12 periods to become a financial year. So this is a particular month. Now, let's see how to record. And also remember that in the previous video, we explained what you need to use. We explained the formula. Everything has got a formula so that you don't end up being lost. You don't end up at the wrong destination because you have a formula, you know what you are doing. Your knowledge is well grounded such that you can even correct yourself. You can look back and say, oh, here I made a mistake. Because you have got the principles. You got the principles. You know? The principles are within you. You can judge. You can judge by yourself. So, 1st June, we started a business putting capital in the bank. Okay? Now, how do we record that? Okay? So, we said that for you to record, you start by identifying the accounts that are involved. That's the first step. which account and which account do you need to open? In this case, I have to open the capital account and the bank account. The capital account and the bank account. That's capital, and that's the bank or bank. That's a bank account. This side is a debit, left side is debit, and then right side is credit, and then here is debit, and here is credit. Now, you need to enter those transactions. You have already succeeded in identifying the accounts. Then the second question, if you refer back to the previous video, you'll find that when it is capital, we said how it behaves. When is an asset, because bank is an asset, we already explained how it behaves. So you'll find that your capital will always increase when we credit. Your asset will always increase when we debit. And we said by default, this is a debit balance, and by default, capital is a credit balance. So you debit the bank. We don't have space for putting the dates. You put the date and put the sign of the currency, because this is money. Money is denoted in currency. So you come here on the debit side of the bank and say capital is the other account that carries the other entry. Yeah, that's capital. How much? 20,000. Our space is not so good, so 20,000 debit. Okay, debit capital. Then you go to the capital account and complete that entry, because remember we have to observe the double entry system, the double entry concept. Yeah? For every debit, there is a corresponding credit entry. Corresponding. Okay? So you come here on the credit side and say bank. Of course, you have to put the date. Say bank 20,000. 20,000. You have already managed to record the first transaction. It was credit, capital, debit, bank. Meaning the money in our bank is increasing. We've got more money in the bank. And we are now having the capital in the bank account of this business. That is how that transaction goes in. And when we are still here, bank, why are we saying debit bank? But when we look at our bank statements, when we have got money, it shows credit balance. You see that sort of contradiction? Yeah? We are saying that when we have money, you show a debit. But when we look at our bank statement, it is showing a credit balance when we have got money in the bank, and a debit balance when we have withdrawn our bank. Why is that the case? For a moment, why is that the case? Is a question. Why is that the case? Now, the case is that the money you put in the bank is your money. That's why we are showing a debit balance. But to the bank is a different entity. It has taken your money. That money does not belong to the bank. So, you, to the bank, you are a creditor. Whenever you take money to the bank, you become a creditor. Meaning that the bank will show you as a creditor. In the books of the bank, you are going to appear as a creditor. Meaning that your account will show a credit. Your account will show a credit. Just like all the creditors' accounts should show. That's the flip side. The flip side of these transactions. To you, to us now, as a business, is our money. But once it goes to the bank must treat it as a money that belongs to a third party. That is why it is credited. That's a nitty-gritty in accounting. I hope you can note that. It's a nitty-gritty in accounting that confuses many. It confuses many. Why are we saying we are debiting and yet by bank statement is showing me the opposite? Yes, it is true. It's the opposite. It's the opposite because the bank is holding on to your money. As you withdraw it, that balance keeps on decreasing, meaning that liability to the bank decreases as you keep on withdrawing and withdrawing and withdrawing. I hope you can see that nitty-gritty, hidden nitty-gritty in accounting. Now, when we are still here, we are saying the bank is an asset. And remember, we have got so many categories of assets. We have got depreciating assets, we have got appreciating assets, we have got intangible assets. And remember that the intangible assets are assets with very high values. What are these intangibles? You have got your trademark, you have got your patent, you have got your licenses, you have got your research and development, you have got your customers list, you have got your goodwill. All those are intangible assets. And when you are recording them, you will do the same. When you are recording them, as long as it's under the category of assets, when you are recording them, whether it is a big asset, it's depreciating, doesn't depreciate, it's an intangible asset. When you are recording them, you use the same means, the same formula. That's what you do. So as long as you know how to deal with one, then the rest will follow in the same direction. Okay, let's look at the next transaction here. Very fast. Moving very fast. We bought goods on credit from PK and DK. Now, when you buy goods on credit, this is what happens. You open two accounts. The first account is purchases. Purchases account. This account has got the characteristics of an asset. Already you know in your mind, asset is debit, if you want to increase them. So, you have the debit side, you have got the credit side. Okay? The other account involved is that account of the creditor, PK squared. PK squared is a creditor because we haven't paid them. We bought on credit. You see? It is a normal way of doing business. So what will happen is that our asset will take the debit and our creditor will take the credit. Looking at how we analyzed our elements. That's where we are getting the formula from. We are not guessing. There's no guessing in accounting. Please, there's no guessing in accounting. If you don't get this, you pause. You pause until you master for you to move forward. Don't move anywhere before you master this. Don't move anywhere before you know what are the elements. Because it's going to be effort in futile. You'll be lost. You'll not have a GPS to trace where you are. Alright, so what are the figures? Let's look at the figures. Okay, the figure is 3,000. So 3,000, you debit your purchases. The other account is PK squared. Of course, you put the dates. I have no space for the dates. PK squared is 3,000. 3,000. Then you come here and say purchases. Here you say purchases 3,000. So it means that your purchase, it means that you are buying and selling. When you're buying and selling, your goods, depending on the nature of your business, that's how you have your purchases, because you end up selling that stock. You buy the stock, then later on you sell that stock. You get that? So that's why anything, all the goods that are required to be sold out requires to be recorded in the purchases account. Okay? So we have now increased our liabilities. These are creditor 3,000, and we have increased our purchases 3,000. We have identified the account and we have recorded. Let's move on and see. On the same date, which is June the 2nd, we also bought goods from DK. We bought more from DK. So open a DK account. DK account, there is debit and credit right there. Then the other account involved is purchases. So what you're going to do, you come to the purchases account and say DK. DK is here. The other account involved is DK. Then an amount of what? An amount of 1,200. 1,200. 1,200. That is DK. Then you come to the DK account and you say purchases. Purchases 1,200. I hope you can follow so far. You can follow so far. DK is a creditor, purchases is an asset. When you want to increase an asset, you debit. When you want to increase a liability, you credit. So we have got that. Okay? Then we go to the next date. The next date is we paid some insurance is an expense. Insurance is an expense. We open it, insurance. And let's remember this. This account, once you open it, you don't open it again. Once it is existing, you keep on recording to that very account. And that's the essence of accounting, whereby we classify, we group things together so that we can sort them together, so that we can filter them. Yeah? We bring everything together so that we can be able to process. So, as long as the account is open, you don't open it again. So, we didn't have an insurance account. So, insurance is an expense, and we know what happens to expenses. If you are to increase them, you debit. It's just like what we do to the assets. So, here we are. Our insurance is how much? Is £850. So, you come here and debit. How do we deal with it? The other account involved, before we go there, is the bank. You also open, the bank account is already existing. You cannot open it again. It's already existing. So you come here, debit here, bank, debit, credit. So you say bank, and then 850. There you are. And then you go to the bank, you now credit. You credit the bank. You know, with insurance being the details. Of course, you put the dates. Put the dates for me, I have no space. And also put the currency for me, I have no space. Okay? So, you have now recorded your expenses. So, your expenses are already eating on the money that was existing in the bank. We had 20,000. It's getting eaten. It's getting eaten. Now it's reducing. It's getting eaten. It's reducing. So 20,000 will reduce by 850. The new balance is no longer 20,000. You have to note that. When we credit in this account, we are reducing. You see? So you can see that. Let's check and see what follows. What follows is the cash sales. So, we do not have a cash account and do not have a sales account. So, it's our opportunity to open the two accounts. Open cash account, and cash, as you can see, is an asset. And then open a sales account. And we say sales account can also be called turnover, can also be revenue account. There are so many ways in which it can be depicted. Okay? So, what happened here? Now, sales or revenue, it is under the general group of liabilities and capital. So when you have to increase it, you credit. We said there's no guesswork. There's no guesswork here. So how much did we sell? We sold 15,000. Okay? So you are going to come to the cash account and say sales, this particular date, sales 15,000. You see, after putting the dates, of course. After putting the dates. And then you come here and say, from cash sales, we made 15,000. That transaction, that event has already been recorded. Yeah? It's affecting two elements. One is assets and one is revenue. You see? It's affecting the two. Now, let's carry on. As we carry on, now, June 5, that was June 4. June 5, we paid wages. We are paying wages in cash, 6,000. So we don't have a wages account existing. So we have to open a wages account right there. Wages account is an expense. It's under the general category of expenses. And once you know that, then you know what to do. Once you know that, you know what to do. You see, it is not complicated. Once you know the general category, then you know what to do. Okay, so This is an expense. So an expense has to be debited if it's increasing. So you are going to say what? You are going to say wages were paid in cash. Cash account is already existing. So you cannot open it again. So you just have to take the amount again and say paid wages for 6,000. So you come here and say cash after putting the date. Cash 6,000. Is it? Then you come to the cash account is already existing. You can open it again and say wages took 6,000. So it means what the balance we had in our cash account is now decreasing because we are crediting. Whenever you credit, the effect is that the balance starts decreasing. That's how accounting operates. It's like you are adding and subtracting, depending on the type of the account that you are dealing with. You're already done with the sales account. Not with the wages account, not sales account, wages account. Then, June 6th, it gets a bit spicy. Goods returned by us to DK. We had bought some goods. And when we bought the goods, we had already entered in the purchases account. But now we want to return these goods because they may be faulty goods. They may be the wrong consignment. And when we are right here talking about returns, let us remember that this is accounting and business. Whenever we are returning, that is not good business practice. And the returning will have big ripple effects to our operations. It will have logistic nightmare. It's a logistical nightmare. I want you to think about this. How about if you bought overseas? How do you return? How do you return? So it means that there is something wrong both ways. The seller or the supplier and us, because our buying department must ensure that they screen and use the right suppliers. You see, their KPI should be on how they choose the right supplier, because we cannot be able to deal with goods that needs to be returned after they were received. That is a logistical nightmare. It has got a lot of impact, and the impact will hit on our bottom line. It will hit on our profit because we are going to have dissatisfied customers, delays in the orders, idle machines. We are going to have a whole lot of things. That's why I always insist that it's accounting and business. It's not just accounting. It's not just accounting. It is accounting and business, because you see now, yes, we are dealing with accounting, but we can already see that a problem is likely to occur whenever we are returning the goods. And that's why we record it in separate account. We don't record this in the purchases account. No, we record it in a separate account, because so that we can show that there was some returns that were taking place of which is not good practice. Then we can now start dealing with that. The management must sit and work out a strategy to ensure that this does not happen. We don't need to have returns accounts in our system, in our books. Whenever we have them, they stand for a big problem in our operation. So this is return out, meaning that we are taking back the goods that we had bought from DK. So we have to go to DK's account and show that those goods are getting returned. Okay? So where is the DK? DK is here. We have to debit his account. His account needs to be debited by returns out. Return outwards. Okay? And the amount is 200. That's 200. The amount is 200. So you can see now the balance that he was owing has reduced by 200, because these goods, we are no longer having them. We have returned them. Then we open an account called returns outwards account. Outwards account. Got a debit and a credit. You see? So that account has to be credited. The details are DK. DK, you credit this account with 200. This gets a bit spicy. It gets a bit spicy to be able to know how to record the return out. But for you to know what to do is that you was supposed to reduce your purchases with that amount that DK returned. But instead of that, we are opening a separate account to deal with that. So, return outward is the opposite of purchases. You record it on the opposite of purchases. It's like, effectively, it's like you are crediting your purchases. And why are you doing that? Why are you doing this? Because when we end up now preparing the income statement, your purchases will be reduced by this amount. For that period, your purchases will be reduced by this amount so that you can determine the net purchases. So effectively it will happen. But in the records, we show them separately. We show them separately. So when we are returning these goods to our creditor, we have to raise a debit note. Debit note is what is helping us to debit DK's account. Debit note is what is helping us to debit DK's account. So we return those goods with a note that we are calling a debit note. So when the supplier gets that, in their books we are also existing as a customer. They raise a credit note. That's an integrity in accounting. It's always taken to be complex. They raise a credit note to show that that customer is now owing lesser. It's not owing the full amount as the invoice was showing. You see? Because you can't cancel the invoice. It was already raised. But you can adjust the invoice. So you adjust it with that credit note. For us, when we are returning, we raise that debit note, which the supplier will confirm with a credit note, showing that our account is now owing lesser. You see, because the goods, we are no longer having them. They're not with us. They're already gone out. But the transaction had already taken place before. So we cannot withdraw that invoice or cancel that invoice. So we raise another document to adjust, to correct, for whatever reasons that the balances needs to be adjusted. So we raise those documents that will help us to deal with that account. So in this case, it's a debit note which will be confirmed as a credit note. Always remember that we have got two sets of books. We have got the books of the customer, which we can call our books, and we have got the books of the supplier. So what we do as customers is what the supplier will do on the opposite side, on the flip side. It's another integrity. Remember, there are always two books involved. Our books as the customer, as the buyer, and the books of the seller. And what we do when we are recording is what the supplier will do on the opposite side. You see, when we are customer, the other side we are creditor. When we are creditor, the other side we are customer. So those are two sets of books that you have to carry at the back of your minds so that you don't get overwhelmed. You have to carry that at the back of your minds. Okay, we saw that juicy part. Then, sold goods on credit. Now we are selling. Sold goods on credit to these three people. So let's open the two accounts involved. We have got sales for sure. Sales account is already open. Then, all we need to do is to open now these accounts of, these are now customers. It's not creditor, it's now customers. So JK is one of our customers. We can have our JK here. JK is a customer, debit, credit, and a customer is an asset. So therefore the debit will come into JK's account, and the details will be sales 3.5. 3.5. Then you go to the sales account and you credit Say JK. JK is the other account, which is 3.5. You have effectively recorded that transaction or that event that happened in this particular date, which is date 7, and then you have got GK 2000. So open GK. GK 2000, debit credit, is also a customer. You say sales 2000. That's GK. Then you come to the sales account, say GK 2000. That transaction has been captured. Then we capture MG 1500. MG 1500. You say sales 1500. You are capturing the dates as well, of course. Don't forget to capture the dates. Then you say MG here. MG 1500. You have already dealt with that transaction very, very, very fast. Remember the principles we are using. Remember the formula we are using. By identifying the elements and how they behave. Then we bought motor vehicle. Motor vehicle in cash, 6,000. Motor vehicle is an asset. Motor vehicle. Motor vehicle, debit, credit, and then we say we bought it in cash. Cash is already existing, and then that's about 6,000. So motor vehicle, you say from the cash, motor vehicle is increasing. Cash, 6,000. And this is an opportunity where you can see cash interacting with each other. The cash is interacting, the assets are interacting with each other. The assets are interacting with each other. So then you go to motor vehicle. Where is our cash account? We need to get our cash account. Our cash account is right here. And then we are now crediting it with motor vehicle, MV. MV 6,000. MV 6,000. We have recorded that. It means that our cash is decreasing further. So those are two accounts that are coming from the same broad category of assets. So assets are interacting with each other. One side is increasing, the other side is decreasing. I want you to also see that. I want you to see the nitty-gritties. Now, remember this, or note this. Note this. We said bought, we said what? We said bought motor vehicle. That's what we said. But when we said bought goods, it went to a purchases account. That is something that you also need to note. Note the language that is being used. Don't be confused by the language. When we are buying goods for selling, it goes to the purchases account. But when we are buying other items, then they go specifically to that particular account. So that again must not be confused. Okay, we have already bought all these we've dealt with. You can mark them to show that it's already dealt with. Now we are on bought goods paying by check. Now we are buying goods. So purchases is there and bank is there. So 4.5. Purchases account. Purchases account is here. Purchases account is here. It is 4.5. And it's bank. You debit. Then you go to the bank and the bank will be reducing purchases, which is 4,500. 4,500. You can see how they are counteracting with each other. How they are counteracting with each other. Purchases is an asset is increasing. Bank is an asset is decreasing. Okay. Look at all those nitty-gritties. Now, we have already dealt with that one. Then we go to paid this creditor by check 3,000. Paid PK. Let's pay PK 3,000. PK is existing. We need to pay him. So let's go to the PK's account and we pay PK outrightly. So PK is right here. We are paying bank. What this means is that PK is no longer owing. PK's account is already dealt with. It's no longer owing. It's got a zero balance. Okay? It's got a zero balance. Then you come here and say PK squared. You paid 3,000. And our bank balance continues to decrease. Our bank balance continues to go down. It continues to decrease because we are using it to make the payment. Now, one creditor is sorted. Then go to that particular date, the same date, the 10 is done. Then we go to date 11. Faulty goods returned to us by MG. Now, MG was a customer, is returning to us. And initially, we had shown that in our sales account. When the customer buys on credit, it affects the sales account. Okay? So, what is happening now? MG is returning those goods back to us. So, we have to open an account called Return Inwards Account. We have to open an account called Return Inwards Account. It's right here. Return Inwards account. And then we go to the customer's account, and the customer we are saying is MG. Go to MG's account. That balance is decreasing, is it? That balance is decreasing. So when the balance is decreasing, is where are we? Where is the MG? MG account. GK, MG is right here. It's right here. So his account is decreasing by returned inwards. 500. Then we come to the return inwards account and we say MG 500. Let's explain this a bit. It means that we issued a credit note such that that note advised that we credit MG's account so that he's no longer owing 1,500. He's now only owing 1,000. So we raised a credit note to effect into MG's account. And that is how the return inwards account came about. But if you look at it keenly, you'll find that it is recorded on the opposite of sales. Sales is here. You see, it's recorded on the debit. Means that it's going to reduce the amount of sales for that particular period. When we are preparing the income statement, in actual sense, we are going to reduce it so that we can get our net sales. You see. But because we want to show that the return is happening, it is why we are showing it separately. So that we can now make the right decisions and the right strategies to ensure that this does not continue happening. It affects so many things when a return is being effected. It affects the whole operation. It affects the whole operation. For example, why are the customers returning back to us? What is wrong with our production? What is wrong with our systems? How about all the other costs, including reputation? Imagine that, including reputation. How about if this customer is overseas? Who incurs all these transportation costs? Who incurs all that? It ends up hitting on our bottom line. That's why I say it's accounting and business. And if at all, for people who believe that accounting is all about balancing the books, then there will be no need for us. Because the machine and the machine learning and quantum computing can do that better for us than we can do. But we are here because it is accounting and business. Accounting is what is showing us the activities of the business in the form of numbers, then we can measure. We can measure those activities, and now we can make a judgment of the performance. You see, that's why I keep on saying it's accounting and business. That's a very critical issue. Mark you, is a very critical issue to understand. Don't just do accounting, just recording and then leave it there. Then you balance over and then leave it there. That will not help anybody. It is accounting and business. Yeah? Very important point. Alright. So that has already been done. That's already done. And we can put a tick. It's done. And then we incur the liability from the bank. So we have to open these liability accounts and record that particular transaction. June 14, we took a loan from Standard Bank. Of course, debit and credit. Always remember that. Then this money went to our bank. How much is it? That money is 35,000. So we go to a bank account and indicate this Standard Bank, that's SB, 35,000 is what we got. And then go here and show your bank, 35,000. So you can see, this is a liability account. It increases when you credit. That's why we have shown 35,000. Meaning that we are owing, effectively. We are, and our books are showing that. If you know how to read the books, you don't need to ask so many questions. You just ask for the books, and then you can understand what is happening. You don't have to be explained everything. You can just pick it by looking at the books. So there is that liability, and our bank balance has actually increased by 35,000 because we need liability sometimes to expand our businesses. We need liabilities to expand our businesses, and always be careful to only go for quality liabilities, not expensive, not extra expensive liabilities. 50% interest, 30% interest. You have to do your shopping and do your negotiation to ensure that you're getting the right liabilities, and also how you use those liabilities. You cannot use the liabilities for fun. You can only use the liabilities to expand your business, because later on the demand will be put upon you to pay. Do you have the cash flows when this money is needed? Remember, the interest is paid irrespective of whether you are making a profit or not. Remember, the interest will be paid on annual basis, by annual basis, and it doesn't matter whether the money is there or not. Remember, the repayment of the principal also has been agreed upon. There is a contract. And remember, people in this industry, financing industry, they are not very kind people. They always have got their lawyers waiting for you to deal with you. So, as much as you take your liability, you are increasing the risk of your business, but again, you need it to expand. So, take it and use it in the right manner. Use it for what is needed. Use it to strengthen the business, to expand the business, but not for other reasons. Not just because you qualify, you just take the liability. It's going to come back to haunt you. That we've done. So we can tick it off. Then we are saying that this proprietor, because he's a sole trader, took some money out of business. How do you record that? It's not complicated. The only thing you do is that you are going to open an account called drawings. Not drawing pictures, drawings. Drawings showing that you are taking money out of the business. So, how you record this is that you took out how much? You took out 5,000 from your cash. 5,000 from your cash. So, you have to credit your cash. Your cash is here. You credit your cash, details being drawings. Those are the details. Being drawings, 5,000. Then you debit your drawings here. Cash, drawings, 5,000. What you need to note is this. These drawings will affect your capital. You see you are debiting. You can just drag it here and see. It's having the same effect. Your capital has decreased. Your capital has decreased. And these drawings can even come in the form of goods. And the same will happen. Your capital is going to decrease. Your capital is going to decrease. That is the effect of drawings. You see? So instead of showing directly in the capital account, you open a new account called drawings. But when you are preparing your balance sheet, in your balance sheet, your opening capital balance will be reduced by these drawings. Effectively, practically, you are going to say capital minus drawings. Practically speaking. But when you are showing the records, you show them separately. I hope you know that. Then, moving on. Then, we have got transport. We pay some transport on our purchases, which is a carriage inwards by bank 1,500. So, open an account called carriage inwards. Carriage inwards, debit and credit. Carried inwards. You paid by bank. So bank debit 1,300 because this is an expense. Debit 1,300. Go to the bank. Credit carriage inwards here. Carriage inwards 1,300. Now you find that this carriage inwards becomes part of the purchases cost. When preparing your income statement, you will add it to your purchases. Effectively, that's what we are going to do. But now in the records, we are showing it separately. But at the end, you are going to find that your purchases, you are going to add this carriage inwards because this is the transport cost you incur to bring the goods so that they can be available for sale. That's why it becomes part of the cost of your purchases. It has to be added to the cost of your purchases for that reason. Then you also have got carriage out. Carriage out is when you send to the customer. The transport cost you incur to the customer, and assume that we used cash. We used cash to do that. So you incur that cost. So carriage outwards. You see, that's the difference. Carriage outwards. Debit and credit is an expense also. But now we are saying we paid through cash. It was, what was the figure again? The figure was 1,600. 1,600. 1,600. Then you go to your cash here and you credit it with your carriage outward. 1,600. You can see how everything is coming together. Now this one is an expense that is going to be dealt with at the P&L and the profit and loss section of your income statement directly. But this one will be dealt at the trading part of your income statement. When you are determining your gross profit is where you are going to deal with this one. This one will deal with it when you are determining the profit. Down there. So that has also been dealt with. So that one can be ticked. That one can be ticked. Now, let's now change the gears a little bit. Let's change the gears a little bit and see how we deal with VAT. For those businesses, entities that are registered for VAT, what happens to them? How do we deal with VAT? How do we record VAT? It's very important for you to know this. Okay, June 30, we have got transactions that are affecting VAT. So we bought a computer at a cost of 8,000. 8,000. This is before the VAT. Note that. And then the VAT was 800. So the cost of this computer is 8,800. because it has already taken care of the 10% VAT. But now remember this is another nitty-gritty, and many people have got a problem here. The 8,800 is not 100%. No, it is 110%. It's 110%. When you add the VAT, it becomes 110%. And when you want to determine the VAT element, assuming that this information is not given, assuming that you are just given 8,800 and the 10%, for you to determine the VAT, you are going to say 10 over 110, then multiplied by 8,800. That's how you get this figure. You're going to say 10 over 110. If it is 15%, you say 15 divided by 115, multiplied by that figure which has got VAT included in it. So you have to see that small nitty-gritty. You always go wrong when you start you start using this figure to determine your VAT, because this figure does not cater for the VAT. This is just the cost before you add the VAT. Just the cost that you have established before you add the VAT. You see? So this is your 100% cost. But you add on top of 100%, you are adding another, because VAT is not your money. VAT is money for the authorities. VAT is not part of your profit. VAT is not part of your profit. Some people may think that it's part of their profit. This must be remitted, and there are big penalties if that is not done. So VAT is not your money, it's money belonging to the tax authorities, depending on the jurisdiction. So how do you deal with this? So we are buying our computer through a bank transfer. Now, you see what happens here? Let's open a computer account and a VAT account. Computer, debit, credit, and the VAT account. Remember, the debit side of the VAT account is the input. That's the input side. And then the credit is the output. This is the input. Input meaning what you buy into your system. Okay? Output is when you are selling, how much VAT are you charging? That's the output. Yeah? When you are buying, how much VAT did you pay when you are buying? Okay? When you are selling, how much VAT did you charge? Then we balance the two and see which side is bigger than the other. If this side is bigger, it means that you have collected so much VAT. It means that you are owing. But if this side is bigger, it means that you have to claim. You must see that movement. Look at that movement. Understand that movement. Yeah? When the input is higher than the output, it means that you paid more. You have to claim. But if at all the output is higher, it means that you have to pay to the authority, because you have collected more money that belongs to the authority and nothing to offset. You know, the input helps you to offset, meaning that those entities that are registered for VAT, their production cost is lesser. Their production cost is lesser because you are allowed to do what? To claim the input from the output. But if at all you are not registered for VAT, it means that your production cost is going to be high. You see, you will not be very competitive, because the only thing you can do is to pass that cost to the customer. But even if you are to do that, remember there are other players that are out there that are also providing the same service or the same goods. So you may not be able to do that. So it means that your profits will be thinner and thinner. So it's a big advantage when you are registered for VAT for that reason. So how do we record? Most important, how do we record? Now, we are saying that. What are we saying? We are saying that our computer is paid through a bank transfer. So you credit your bank with the full amount. That's another nitty-gritty. Credit your bank with the full amount, 8,800. 8,800. 8,800. The computer that you are buying, where is the bank? The bank is here. Yeah? You credit that computer. You credit with 8,800. Then you come in here. You come here in here and debit from the bank, debit. You are only going to debit the actual price, the actual cost of the computer is what you are going to debit. And then the other debit goes to what? It goes to the VAT. That's your input tax. 8,000. Not 8,000. Not 8,000, 800. 800. 800. I corrected that. 800. Such that these two debits, if you add them together, they amount to 8,800. And the credit is what? 8,800. So you can split, you are able to split an entry into two accounts. You can split as long as the overall is that the same debit was done and the same credit was done. Look at that small nitty-gritty. You can split the two. Right now we have split. One went to the computer because that's the actual cost of the computer. The other one is a VAT, is input. Imagine there's nothing else that is happening. It means that this money you can claim. This money you can claim from the authorities. This money you can claim from the authorities. Imagining that nothing happened on the output. Okay? Then let's see the other transaction. We have split the two transactions. Huh? The other one is that we sold goods on credit to GK at the cost of 4,400, meaning that the aggregate figure is 4,400 and the rate of the VAT was 10%. So how do we record this? How do we record this? We sold further goods to this guy, so we have got the sales and the creditors to deal with. 4,400. So the sales. Let's start with the creditor. The creditor is DK or DK. The creditor is DK. GK. We have to look for GK. GK is here. Yeah? So GK will take the full amount. Okay? We'll take the full amount. That is sales. We take the full amount of 4,400. Meaning that GK is going to be owing the amount which includes that VAT. Okay? Then we go to our sales account. Our sales account is here. So we credit our sales account with that is GK. GK this time is going to be 4,000. 4,000, and then the other 400 from GK is going to go to the VAT account because this 400 is in respect of VAT. So you can see our credits are how many? There are two credits, 400 and 4,000. You put them together is 4,400, which is represented by what we put in our GK account, in our customer's account, which is 4,400. So the customer will be owing 4,400, but we'll split it into two. One goes to our sales, 4,000, and the VAT goes to the owners. Now, when you look at this, you can see now things have changed. We have got more input, VAT, than output. So you are going to net out the output to know how much to claim. In this case, you are going to claim 7,600 from the authorities because that's the balance that is remaining. So that's how the VAT operates. And what is important is to look at how we are splitting. And we should look at the account that carries the aggregate figure. Then look at the two accounts whereby we share. One goes to the actual cost, the other one goes to the VAT. Such that now the VAT matter is isolated right here. It's isolated right here. It's dealt with separately. Now, having done that, let's remember that once you record these transactions, the next thing you do is to balance off. You balance off these accounts. Depending on the period, depending on the size, depending on what you are using. Are you using a manual system or an automated system? Automated, very good for you because you just press some buttons. But manual, physically, you make the entries. But the end result should be the same because the principles are the same. The principles for manual, principles for automated are the same. Okay? Alright, so you have to come up and now balance of these accounts. Now, balancing of the account entails what? It entails looking at both sides. Come to the debit side, right here, and the credit side, right here. Look at the side that has got the biggest value. Which side has got a big value? Automatically this one, the credit side has got the biggest value, which is 20,000. So that figure you put it across, you put it on both sides. Once you establish the big value, put on both sides. Then you come here and now determine what is left for this side also to have 20,000. What is left? What is needed to ensure now the debit and the credit are at par, are at the same level. So in this case, because we didn't enter anything here, our balance carried down. It's always carried down to the next period. Okay? It's going to be 20,000. Yeah? At the end of this month, 30th June, you have balance off. This 30th June, you can put the date. You balance off. This balance carried down is going to be carried on the credit side. Remember this. Balance brought down and balance carried down cannot be on the same side. It's a negative and a positive. It's a negative and a positive. Cannot be on the same side. That you have to note. So, at the beginning of the following month, which should be July, we are going to have balance brought down of 20,000. Balance brought down of 20,000. Because if it's carried down on this side, it's brought down on this side. If it's carried down on this side, it's brought down on this side. At the beginning of the following period. So the same will happen for all these accounts. You balance off these accounts using the same concept. Look at the side with the bigger value. This is one which is going to help you to know what is missing. Yeah? For the scale to balance, not to tilt on one side. What is missing, you insert it as your balance carried down, irrespective of the side. So once you know the big value, you put it across, both on the debit and on the credit. Then you now determine what is missing. That figure that is missing to make everything balanced. And once you determine your balance carried down, remember that it's brought down on the opposite side of the following period. We have said that already. Now, after you have balanced off all the accounts, then you need to extract a trial balance. Extract a trial balance from these books. And these books are diverse. Some of them is purchases ledger, others is sales ledger, others is general ledger, others is cash book. These books are diverse. You are recording in diverse books. We're just showing them together so that we can be able to explain the subject matter that we're explaining. But otherwise, some of these accounts are found in different books. Because in accounting, we classify so that we can be able to even delegate, so that we can isolate, we can quarantine problems. Yeah? Like the cash book, somebody is responsible. The sales ledger, somebody is responsible for that. The purchases ledger, somebody is responsible for that. The general ledger, somebody is responsible for that. You see? And then, at the end, we bring everything together. Depending on size, of course. Small operations may not need those elaborate books. You know, they may not need all that, because that also it comes with a cost and it will not be necessary. But the big ones, they will end up having all those books that I've mentioned. So these entries will be recorded in the different books. So you balance them off at the end of the period, then you extract a trial balance. This trial balance, you can extract it on monthly basis, or if it's a small entity, at the end of the financial year, so that you can now prepare the financial statements. You can never be able to prepare the financial statements without a trial balance. A balancing trial balance. It is correct, it is balancing, no errors. That's what helps you now to prepare the financial statements at the end. You see? So when you come here and you want to extract the trial balance, what are you going to be looking at? What are you going to be looking for? You'll be looking at all these balance, the balance brought down. That balance, you see like now, is a credit balance. Yeah? If it's an asset, it's going to give us a debit balance, definitely. The balance brought down, depending on the side in which it is, you just take it and paste it in your trial balance. You don't have to scratch your head about it. You don't have to think about it. Look at your balance brought down. Where is it? The side in which it is, you just take it and paste it in the trial balance in the right column, debit column or credit column. Just pick it like that. Don't think about it. It's already correct. So you just pick it and transfer it to your trial balance. It is just like that. It's just done like that, whereby you master, you know what you are doing. Yeah? You just master and know what you are doing, then you transfer all those open accounts or accounts with balances. For example, there's one account that we paid in full. This account will never make it. This one will never make it to the trial balance. This one can't make it to the trial balance because it's got a zero balance. Any account with zero balance cannot go to the trial balance. That is very important for you to note. Okay, so having said that, I think now what is left for you is to practice how to enter these entries. And as you can see, it's a very exciting journey. It's a very exciting process. Very exciting process. And I hope that you have followed and most importantly, you have enjoyed. So my name is PK, and as I said before, I'm your accounting nitty-gritty specialist, and I'm also a corporate trainer and a consultant, and I've consulted for many entities in collaboration with the big and reputable institutions like the Institute of Internal Auditors, Institute of Chartered Accountants, in which we have devised some CPD topics that we have used to train the members. And also, I'm very eager and excited to deal with the board committees and board members, especially during the induction stage, because it's so difficult for somebody to manage from the top, and you're managing from the top, yet you don't have enough information and you don't have enough time. So I have got the nitty-gritties that are required to make you effective in that particular work, especially the audit risk committee is my exciting role that I play, and I play it very, very well, such that you know where to start. Because as I've always said, I always ask this question, where do you start? You know, so much information, so much data, and you are expected to analyze it, go through it, and make decisions. I'll be able to show you where to start. I also deal with the risk register. I'm excited when I'm drawing up a very robust and practical risk register to show you the areas that the business have to safeguard, the most important areas the business is required to safeguard. And having said that, I think we have come to the end of this video. Please go back to the previous video because they are connected in a way, and also like and subscribe. That's how you can support us. And goodbye for now. Thank you.